Hello and welcome back to episode 8 of our e-guide for the buy-to-let blueprint. If you've missed any episodes, you can follow on our socials to catch up. Today we're focusing on numbers that matter. And so in general, when we're talking about numbers, we're talking about income, costs and appreciation. If we're looking at income, because a lot of people focus on income to start off with, what we generally say to clients is you need a fair buffer between the amount of income that you're generating and the costs that you're going to incur. Now, in general, when we're looking at numbers, we want to achieve a minimum of 5% yield on any property. And in reality, we want to achieve much better than that. But anything less than 5%, you're running into risk, especially with leverage properties, that you're paying 5% interest, you're 5% returning, your costs are probably going to eat into all of the rest of the returns. Now, this isn't always a rule of thumb, because sometimes you'll look at properties where you're generating 12% return and your costs are 15, 18, 30%, especially if you're looking at higher risk strategies. So you want to make sure there's a good buffer between income and costs. Secondly, growth should be based on fundamentals, not on forecasts. So the general UK market has many different forecasts about where it's going. Certain areas will outperform or underperform that depending on what the property is and where you're investing into. And so what you want to make sure is that you're looking into the fundamentals of those specific areas. Again, with anything that we look at, 5% is sort of the magic figure. We generally don't want to invest in areas where we think we're going to get less than 5% growth on an annual basis. Really, the important point here is that return on cash, so how much equity you put in versus how much return you get out into your bank account, is the most important. Forget about high level figures, forget about high level yields. You want to work out, if you're investing £100,000, how much after all costs is coming back into your bank account. Lastly, on that, leverage. So obviously leverage impacts your outcomes, generally amplifying it. So if you're investing in an area where you're getting 5% growth in a property, but you're only putting a quarter of that money in as cash, if your income covers the costs of the interest rate, then a 5% growth is equivalent to a 20% return on the cash you put in. And that's really where leverage can help within property investments. So if these numbers work on paper, pretty much every time the investment works in practice. Now, in the next episode, it's going to be our final episode of this e-guide. We're going to bring the blueprint together, so follow along to catch that one, or head over to our website, ethirapropertygroup.co.uk, for any more information.